In 2001, the world map showed the United States as the primary trading partner for most nations. Over time, that map gradually turned red. Country by country, China overtook the US and became the world's leading exporter. This transformation was not just economic, it was geopolitical. The US responded with a dramatic and aggressive trade war. But many experts believe this came too late. Prominent economists claim that China has now reached escalation dominance, suggesting it holds more leverage in a prolonged economic conflict. Ray Dalio, a globally respected macro investor, believes that the current struggle between the US and China mirrors a familiar historical cycle. A new power rises, first through trade dominance, and then by challenging the reigning reserve currency. If China manages to replace the dollar, the consequences could be dramatic. The dollar's collapse would leave the US struggling to finance its global military presence, while China's global influence would surge. Still, there is pushback against this narrative. Treasury Secretary Scott Bessent has highlighted a key asymmetry. The U.S. imports far more from China than it exports. This means that China may suffer more if trade barriers rise. And crucially, many overlook how unique the dollar's role is. Even though it is no longer backed by gold, it remains the global reserve currency. Historically, it has taken decades for new powers to displace existing currencies. When Britain passed the Netherlands in trade, it still took nearly a century for the pound to replace the Dutch guilder. Similarly, the US only dethroned the British pound after World War II, even though it had surpassed Britain in industry much earlier. Dalio's historical pattern reflects how rising nations first excel in exports, then accumulate gold, and only later take over reserve status. But this was in a world tied to the gold standard. After 1971, the US ended the dollar's link to gold, and something unexpected happened. Rather than collapse, the dollar became stronger. American trade deficits grew, yet its currency remained dominant. Even powerful export-driven economies like Japan and the European Union could not overtake the dollar. Japan's rapid growth slowed down. The EU, with its massive population and manufacturing strength, still couldn't push the euro ahead. The reason? Trust. Global reserve managers prefer the dollar for two main reasons: safety and liquidity. The U.S. offers legal protection, relatively stable policy, and deep capital markets. And crucially, exporting to the U.S. remains the most reliable way for developing nations to earn dollars. That access builds deep ties to the dollar system and keeps global demand high. This system brings enormous advantages to the U.S. It allows the country to run massive deficits and still maintain a strong global military footprint. But it also weakens domestic industry. A strong dollar makes exports expensive, driving deindustrialization. That economic imbalance helped fuel the current trade war. From Washington's point of view, regaining industrial strength is essential. Meanwhile, China's goal is even more ambitious: replace the dollar as the global reserve currency and cement its role as the dominant power. By raw output alone, China's economy may already be larger than America's. And although official Chinese GDP figures are debated, the numbers suggest momentum. But this isn't just about size, it's about strategy and trust. After the US froze Afghan and Russian reserves, many nations began searching for alternatives. And Trump's unpredictable policies made the dollar look more risky. If China made its currency more appealing, a major shift could begin. To do so, China would need deep reforms. It could start by making its central bank fully independent, allowing free capital movement, and guaranteeing that foreign reserves are protected from political retaliation. These steps would reassure central bankers. Next, China could open its consumer market to developing nations, just like the US did during the Cold War. Allowing those countries to sell into China without being overwhelmed by Chinese exports would build trust. Finally, China would need to stop suppressing wages and manipulating the currency. Higher wages would boost domestic consumption, while a stronger renminbi would increase global purchasing power. If all this happened, the renminbi could become a compelling alternative to the dollar. Developing nations might pivot their exports toward China, shifting global economic gravity. But none of this has happened. The current Chinese leadership resists these reforms. There's an ideological commitment to export-driven growth and a political reluctance to give power to independent institutions. Until that changes, China cannot fully challenge the dollar's dominance. On the other side, the U.S. has a path to preserve its position. Before Trump, China's growth pattern looks similar to Japan's and Europe's, a fast rise followed by stagnation. The U.S. seemed secure, but Trump's approach disrupted that. He applied harsh tariffs and unpredictable policy moves. Instead of reinforcing American advantages, he created uncertainty. The dollar became more volatile, making it less appealing as a reserve currency. Still, there is a possible scenario where the U.S. reasserts dominance. If future leadership chooses a moderate path, implementing thoughtful tariffs, supporting strategic industries, and reinforcing trust in the rule of law, the U.S. can regain its footing. Strengthening institutions like the Federal Reserve and encouraging legal immigration to support innovation would help the U.S. stay ahead. Meanwhile, China's failure to reform would keep the renminbi weak. Eventually, even developing countries may resist Chinese exports due to oversupply and trade imbalances. But this scenario depends on major political changes in the U.S., which currently seem unlikely. That brings us to the most probable outcome: no one wins. The global order shifts from one hegemon to a multipolar system. Trump's chaotic policies reduce the appeal of the dollar, but Xi Jinping's resistance to reform prevents the renminbi from rising. In this outcome, the world divides into three major trade zones: the U.S., Europe, and China. Each zone has influence, but no single power can set global rules. China remains the top exporter. The U.S. stays the biggest importer, but neither can dominate. The global economy becomes fragmented. A new era begins, complex, unstable, and defined by shared power rather than absolute leadership. And while this sounds like a continuation of the present, it signals something deeper. Economists now recognize this moment as a shift in global structure. The age of a single hegemon may be ending. What follows is a new phase, where economic strategy, currency policy, and geopolitical influence are more competitive than ever. Thanks for watching InvestingFlix. If you found this video helpful, don't forget to like, share, and drop a comment below. For more expert insights on personal finance, investing, and wealth building, hit that subscribe button and turn on notifications so you never miss out.